Okay, so I think there's going to be a market downturn and a recession, and I'm going to show you a tool that you can use to try to market time your entry points, which is the hardest thing to do in investing, is timing your trades. So I'll show you first the account and what I plan to do with the account for a while, and then I will dive into the market tool. So this is the market tool, first of all, to show you. It's the federal funds interest rate, believe it or not. And this is my account here. So I'm sitting at 141 at the moment. Have a few options going, and then I only have 3 positions plus cash. So 200 shares of Apple, 478 of Realty Income, a little bit over 1K shares of Main Street Capital, and 37 and a half actually $1,000 worth of cash just sitting in my brokerage account. Here's the investment tab. You can see the breakdown. So cash versus stocks and options. My 3 positions, all of them are in the green at the moment. My largest one now is Main Street Capital. It's no longer Apple. Imagine that. My most profitable one, still, these are long-term gains by the way, is Apple. This account has been cleaned out quite a bit. I mean, if some of you guys have been following this for a while, been checking out this video log every once in a while, you'll know that this used to be extremely risky at some points. Even last year, when I didn't believe the hype, I didn't think that the markets would drop as much as they did, at least not the stocks that I was holding, but I was wrong. And so let me show you a little bit of brief history here. So this is the 1-year chart here. Oh, it's actually in the green now. But the old time chart, it topped out without the $42,000 that it took out. This was $212,000. But let's go by the chart. So 170, and then wild swings up and down. 103, 140, 195, and sitting at 141 right now, which is a lot more conservative than it has been. The last 3 months has been looking pretty flat. After the initial January surge, it's been basically climbing like $1,000 a month. And so this is the account. This is what I'm doing. This is how I'm waiting, basically. I am waiting for this event to happen. And this event is declining stock prices due to a recession. So what makes me so confident? Let's get into it now, right? What makes me so confident there's going to be a recession? I'm not that confident, but the market timing tool that I'm using is basically the federal funds rate, which can be found on the St. Louis Fed website. Well, actually, just type in FRED and you're gonna find it. So Fred. And this is basically it. And so what you'll notice here is that, first of all, a couple of interesting things before we get started. Rates, this zero rate interest rate environment, okay, or near zero, is not a new phenomenon. Okay, we think we're so special in the 2010s and 2020s that we've had such near zero environment for so long. Well, yes, for that length of time, sure, but we've hit zero rates before. Check this out. In 1958, right, 1958, we hit 0.25 federal funds rate, Fed funds effective rate, 0.25. Do you see that? 1958. So this was a low rate environment here in the 50s and 60s. In 1960, we hit 0.25. Just a touch, but still, we stayed for quite some low rates. Look, this is 0.5. All right, in 1961. So we've been at these types of rates like way back in the past, 70 years ago. All right, so it's not a new phenomenon, by the way. So what you'll notice here is that, this is nothing new, but I just want to point it out just for people who don't know or have never thought about using this data as a timing tool. what you'll notice is that when signs appear that things are not going well, the Federal Reserve traditionally is obliged to basically lower rates. And so you'll see that the grayed out area here marks a recessionary period. And these are usually applied retroactively. What that means is that they put the gray bar there like 3 or 4 quarters after the recession's like ended, because you can't get a clear read on the data unless there's been some time for the data to settle. So they come in and then they slap the gray bar on like well after the fact. What you notice is that in the middle of the recessionary period or a little bit preceding the recessionary period, the Federal Reserve tends to drop the interest rates because we're in recession. Things are not going well. All right, we're losing employment and whatnot. Okay, so you notice that happens once here, twice before a recessionary period, 3 times in a row. Okay, 1969, 1970, and then recession after the Fed has already started to lower rates. Okay, this time they were kind of late to the party a little bit. It was a recession already for a few quarters, and then boom, a huge drop from 13.3 mind you, to 3.87. Right? Here's another one here. So that's 4 in a row already. 5 in a row? Okay. 1980, boom. Okay. From 1985 to that's a percentage, not the year, to 9.93. And then they climb back up again and down again through the recession, the next recession. So that's 6 times in a row. Boom. Look at this, lowering rates through the recession, 7 times in a row. Look at this, preceding this recession in 2001, rates were starting to get dropped already at the year 2000. Okay, before the year is over, rates were already going down. And now the entire economy falls with the rates. So the mistake, look at this, it happened again here in 2007. Boom. Right? They started lowering rates in 2007 before the recession. So it's foreshadowing. Look at here. Even though, yes, 2020 was anomalous, is the same thing happened. So without a fault, every single gray bar that's on this chart, okay, we're given a signal by the Federal Reserve that a recessionary period is coming. Okay, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 out of 10. 10 out of 10. 10 out of 10. Every single time, same thing happens. Okay, now, so what does this mean? Like, okay, we haven't started dipping the federal funds rate yet, right? The Federal Reserve has decided not to do it yet. However, there are signs of this, terminal rate, okay, where they're going to stay for a while or pause. And typically that's a predecessor for a reversal. So there's actually still quite some time left before the recession either starts. So, it doesn't mean that the market's going to drop tomorrow. But what it does mean, well, tomorrow is Sunday, Easter. All right, happy Easter to those who are celebrating. But what it does mean, right, is that we're near the top instead of near the bottom. And if you think that we're going to have a recession and the market is just going to stay high and elevated like it is right now, you're mistaken. Recession drags the earnings of the companies. Okay, people stop spending money, which reduces the earnings of the companies. And so they pay out less dividends, they have less earnings, and that will shrink their valuations. It just will. We're not going to have a multiple expansion in the middle of a recession when earnings are going down. And there's no end in sight. They just keep going down and down in a spiral as the rates are coming down, incentivizing people to buy those same stocks that are spiraling down. And no one wants to buy it. I mean, that's how the business cycle works. That's why it's called the business cycle. They've coined it like hundreds of years ago. It's going to happen again. Is it induced by the central bankers? Sure. It doesn't really matter if it's a naturally occurring event or induced by the central bankers, or they're trying to mellow it out by lowering interest rate going into a recessionary period like they have been doing. But the rationale doesn't actually matter when it comes to just end result. Okay, it's not that important to be right. Like we're out here trying to make some dollars, right? Or money or whatever, trying to build wealth. Like, I'm not smart enough, and I don't think anybody else is smart enough to have figured this out. The people at the central bank think they have it figured out. I don't believe them, but they certainly have the confidence that they can handle this, economy, and they use all kinds of analogies like steering ships and whatnot. But, I'm not sold. But what I am sold on is the effect that they're having on valuation, on the price of businesses. And so we're going to go with that, every single time. So is a recession coming? Probably. Traditionally, every time that the rates have been hiked, it pushes the economy into a little bit of a downward spiral. 10 out of 10 times, basically. So I don't think this will be necessarily anything different. We might be in an elevated rate cycle environment like we had in the 1990s. But all that is irrelevant, okay? We're just looking for the gray bar and opportunities to buy more shares. So like I said, what am I doing about it? I'm doing this, okay? I don't know how long I'm going to manage to stay in cash. I usually always itch to buy something with that cash, but it's collecting, 4.4% with Robinhood Gold right now, which is pretty high interest rate. And I'm basically getting paid a little bit of money to just sit on my hands and make sure that I don't do anything. Am I going to do some credit spreads or some calendar spreads, or going to sell options against some of my positions? Sure. Yeah, I still want to collect that data, but it's not going to be probably the right time to make drastic moves right now when the chances of a market event is increasing with every single day going by. Okay, so hopefully you enjoyed that, or you found that timing tool useful. It's not a secret. I didn't discover it, right? People use that all the time, and they know. But the thing is, the lag is so large between when things start going bad and the Federal Reserve hits the rates with a hammer, and then the eventual downfall of the market, whenever it decides to happen. We don't know exactly when that's going to happen, but the chances are increasing there's going to be a market event with every single passing day with rates this high and so much debt out there, in the economy after a prolonged low rate period. Let's take a look what happened here in the 50s actually. How long was this period? This period is pretty long. So there's a scenario, there's precedent to, in the 1960s, look at this period of slowly rising rates. You guys see this? With no recession. From 61, the end of 61, 1 point. They started slowly rising. 3 points percent. 6, back down to 4. No recession. 68, 69. Okay, and this is probably some inflationary pressures here. Boom. High rates. Push things over the cliff. Build up debt, right? Had to be flushed down. Lower rates, recession. So it could be a prolonged period, except the speed at which these rate hikes have happened is, it's pretty fast. There is kind of precedent to that over here. these spikes are more aggressive than what we experience now, in terms of percentage, total percentage points. And each time it's happened, besides these two here in the 80s, they have basically forced a recession or predicted a recession. I don't know if the tail is wagging the dog or the dog's wagging the tail. But it's not to say, that a recession is going to come right now. It's just I'm preparing for a market event, basically, at this point. I did not think it was going to happen as we started hiking the rates. And I wasn't right about that. The market plunged, more than 20% last year. So I always thought that there was more risk of a market event when the rates are at their highest, and we're reaching our highest pretty soon. And this is what I would expect, like, to wait for a market for a crash or something like that. So my bad. I could have done a lot better. But anyways, that's my market tool. I'm blabbering now, just not giving any information, so I'm just gonna end it right here. Okay, hopefully I make some more company videos. I saw that somebody posted a comment about Ford, so I might do Ford. I may have done it before, but I'll do another one if I have. Doesn't matter. I'll take a look at Ford. I'm going to look at the numbers, look at some revenues, some earnings, some dividend history, some debt, their situation, equity situation, their stock issuance, etc. And I'm going to help everyone come to a better, more understanding idea of whether or not Ford is a good buy. All right, I'm going to end right here. Peace out.